Hi, everyone. I'm Pamela Hastings. I hope you're really well. Welcome to another Barometer Webcast. It is the end of August and we are still staying safe at home. Today, we are going to do a brief overview of current market and economic conditions. And joining me is David Burrows, our Chief Investment Strategist and President at Barometer Capital. Hi, David.
Hi Pam, how are you?
We're great. Thank you.
Well, we've actually got quite a few folks on the line today. What I thought I'd do is actually a little bit impromptu, kind of talk through what's going on over the last couple of weeks, and just to be clear, the things that have been going on through the summer just continue to be more and more accentuated. So just quickly, on your screen is Pam. You can see that, okay? Okay, is the TSX. So TSX is down about 7.4% off the February highs. On the other side of the border, the S&P 500 has been very strong. It's now up 3-4% on the year, and it's a very bifurcated market. Today, for instance, in the NASDAQ, the 6 top stocks accounted for virtually the entire gain on the day. So within the S&P, those 6 stocks account for almost 30% of the index, which is now far greater than what the biggest stocks accounted for in 2000. But they just continue to truck along. So the NASDAQ is on an absolute tear. On the other hand, the Dow, the industrials, still sitting well below the highs, about 4% below the highs, and the Russell 2000 actually, even more accentuated from that, still down about 7.5%. So small cap underperforming, large cap outperforming, technology outperforming, industrials underperforming. So just to put a point on it, it's really quite a remarkable market that we're in. Just to run through the top stocks, Amazon continues to truck along. Apple continues to dominate in the consumer electronics and services. Even Netflix today, after consolidating for some time, had a good size move. It was announced this week Salesforce.com would go into the Dow. They reported great earnings. For a large cap stock to be up 25% is really quite remarkable. I'm not sure I remember that, even that in the late 1990s. So this is the space you have to be in. If we take the tech ETF, XLK, hitting new relative and absolute highs today, and that is the absolute dominant leadership. Following behind technology has been consumer discretionary, and again, really driven largely by Amazon and a couple of companies coming along with it. And then healthcare has been very strong until recently, which has been sort of consolidating over the last 2 weeks. Different than the large cap growth stocks, you've got some materials that continue to chug along. And we talked about the fact that golds had been consolidating over the last couple of weeks down into the moving averages. This is the ETF that is large cap gold. This is the junior gold ETF. And this is the silver ETF, which holds the silver miners. All of them consolidating, all making a nice reversal higher and performing extremely well. So this is a space that we've had to focus in. Single stocks within this group, Agnico Eagle, Barrick Gold, also Franco-Nevada continue to perform really well, and these have been places to focus in. What's a little bit disconcerting is that we continue to see big parts of the market underperforming. And so, for instance, when we look at the Russell 2000, part of the issue here is that in the makeup, you've got quite considerable weight in the financials. So this, again, is the bank ETF for the US market, still down about 33% on the year. And there's a fair bit of energy. The XOP, continues to underperform. In fact, made a new 3-week low today. Over the last week, we've had many, many more declining stocks than advancing stocks. And that's fine so long as the leadership continues to withstand the news flow, and it has done that. So we are very focused in these 3 or 4 groups and really trying to avoid the groups that are underperforming. Now, when we get into the sectors that act like bonds, we note that if you take the long-term U.S. government bond, it's been backing off over the last couple of weeks after making two successive highs. That's interest rates going a little bit higher. Tomorrow, Fed Powell is going to make a case for why it is that we should not be concerned about inflation anytime soon. And the fact that inflation has been below trend for so long is a reason to let it run hot for a while. So that's having a little bit of an impact on the long end of the bond market, because investors believe if they keep short rates low for an extremely long time and don't worry about inflation, it can be a risk for longer term bond investors, and the long term bond yields could go higher. And that puts a little bit of pressure on the sectors that act like bonds. And these would be sectors you would tend to focus on in the income portfolio because they're big dividend producers. So the utilities, the telcos, and the REITs all continue to sort of significantly underperform the market. So it's a market where targeting makes an enormous difference. And we're finding that not only are there the big sort of six stocks, and we own 5 of them, that have been really driving the bus, but within this theme, it's been a sort of an important camp. So we've talked a little bit about Adobe over time, the software stocks in general doing remarkably well. Adobe is a leader in digital marketing, and it's really a necessity for anybody who is putting content up on the internet, especially if you're focused on e-commerce. Sea Limited, which is a company we've been in for some time, focused on video games and internet commerce. Activision Blizzard, which is in the electronic gaming business. Qualcomm in the semiconductors is going to be a leader within the 5G semiconductor space. SciTime is a company that makes components that go into electronics and into semiconductors. And Cadence Design Systems, another one of our key holdings, which is electronic design, digital design, CAD design, that is being used so extensively to speed up the time to market for products. So really very little has changed over the last week or two. The news on COVID is getting a little bit better. The Fed, I think, continues to be very accommodative. Investor sentiment clearly is becoming more bullish. So we pointed out last week that there is some euphoria in the market. That is something that we have to watch. Short interest in the S&P 500 continues to be low and going lower, which means that if you were to get a pullback, that is one group that would be less likely to be a buyer. So if there's large short interest in the market, lots of people have been short the market. When the market pulls back, that's their opportunity to cover their short. There is not much short interest, but there is cash. And we continue to see that there's close to $4.7 trillion sitting in money market accounts in the US. That's down slightly from just over 5 trillion, but obviously lots of firepower that can be brought back. So look, the value of having a process is significant. I mean, you can think of 10 reasons why the stock market should not be performing well. But the breadth models that we use have pushed us into be positioned in some of these key sectors. Yes, there are things that are extended. When we look at the NASDAQ 100, it is extended away from its 200-day moving average, actually more significantly than any time in history. Apple, to use it as an example, has moved so far away from its moving average. It's sitting right now about 50% above the moving average, which is down $325. Stocks at 506. So these are things that we watch, but in the meantime, they continue to march higher. Our technology weight's about a 30% weight in the portfolio, which is actually just slightly less than market weight. We took it down a little bit 2-3 weeks ago. And if we were to see groups like the industrials and the financials or the utilities start to catch a bid, then it would be an opportunity for us to broaden out the exposure in the portfolios. But for now, It's a market that we just have to stay focused in, watch for signs of change. Over the course of the week, our short-term indicators did improve, and the longer-term indicators generally improve, specifically for the US market. European markets are getting a little bit better, but they really continue to lag, and most Asian markets are lagging. The one area that internationally that is performing well is some parts of the Chinese market. That is the Chinese consumer ETF. We have a little bit of exposure there. So technology, healthcare, basic materials, consumer discretionary really are the key camps. Growth would be the key characteristic in the leading positions and sectors, and very large cap by nature. So that means we're liquid. It means that in the event that we start to see things back off, or the market to start to get concerned about the election in the fall, certainly there's lots that we can do. But in the meantime, this market continues to defy gravity and is working its way higher, and we're participating along with it. With that, Pam, are there any questions that have been put in?
Yeah, Dave, a couple questions actually. Would you be able to comment, please, on what needs to happen in order for energy companies to turn positive?
Okay, so just one moment. It looks like my screen has just gone a little wonky on me. Let's see if I can shut that down. Okay. So, so the question was energy?
Yeah, what needs to happen for energy stocks to turn or tick positive?
Well, it's a great question because, historically you would expect, and I'm just going to punch up here, get the price of oil up on the screen. So if we take the USO, which is the ETF, which is energy, you can see oil prices have worked their way higher. And over the last couple of days, they had a nice bump on the expectation that there is this hurricane coming at the Gulf, which could shut down some production. But the issue is that stocks don't seem to care. And I think one of the concerns is that the Democrats are quite in favor of a moratorium on fracking. So that is one issue. Second issue is that there is lots of excess capacity around the world that is currently shut down because the demand levels are low. In storage, gasoline is running about 6 or 7% above average in inventory. So there really is no notable shortage. And the reality is if demand picks up, supply can pick up. So we have a little bit of exposure here. I think in the equity portfolio, it's about 3%, which is certainly a far cry from where it used to be. We've had times when it's 30 or 35%. But until we see some real signs of change here, it makes no sense. And, interesting to see, Exxon coming out of the Dow. Used to be the biggest stock in the Dow. So that's quite remarkable.
Thanks, Dave. And on that note, we have a question about how solar and wind power companies compare to more of the standard energy generation companies.
Look, this is a great space. So that's the solar ETF, TAN. Now there's some big companies in there. SolarEdge is one of them, and this has been a holding of ours over time. SolarEdge makes power inverters, so it enables taking the DC power from the solar panel and converting it to AC power. They have a particularly strong competitive offering in that they are able to take as much power as each solar panel produces and consolidate it out of the solar facility, where their competitors can only take as much power as the weakest solar panel in the array, which gives them a large advantage. But this is an area that the clean power sector is one that is continuing to get sponsorship. And a lot of that has to do with, socially responsible investing. But the fact is solar is now competitive easily with coal-fired power generation. And so you're going to see, it continue to proliferate.
Thanks, Dave. The next question is about Canadian banks. The Canadian banks broke resistance, and the question really has to do with Canadian banks versus US banks being weaker. I guess you quick comment on the US dollar. And do you think that this divergence between Canadian and US banks will continue? Is
Yeah,
global money coming to Canada?
yeah, it is. And so, realistically, the numbers that have been reported so far by the Canadian banks have been better than expected. They were fairly aggressive at taking reserves against bad loans early on in the pandemic, and they're going to be able to bring some of those numbers back into their earnings. So yeah, they are outperforming. Royal had a really good week this week. If we go through the list, TD had a good week. Commerce had a good week. National Bank had a very good week. So this is an area that we're building a little bit more weight in, and the U.S. banks just continue to lag. So Bank of America would be one of the best, and you can see considerably underperforming the Canadian banks, and that's a bit of a surprise. They are very, very inexpensive. But at this point, because the COVID cases continue to be much more significant in the US, there is more risk of bad loans. And we'll see as things improve whether they can certainly start to perform better. If the bond market continues to weaken, that's a positive thing for the banks in general, because a steeper yield curve means that they can borrow short by way of taking in deposits and lend long and charge a higher rate on the loans.
Thanks, Dave. That concludes our questions for today. Do you have anything further, or are we gonna, this one's a short update?
Well, we're constantly watching for change. And what we would really like to see is for this rally to broaden out. And so we're invested. And the equity portfolio, the long short portfolio, well outperforming benchmarks, income portfolio way outperforming the equity income index or the high dividend index in the US. We watch for signs of correction, and that's why we worry a little bit when some of the key groups are not participating. But when you get the leading stocks breaking out and taking out highs, Facebook today had a giant day. And so when you get the leading stocks doing that, you'd like to start to see the rest of the market follow along. And so we'll see whether that takes place over the next couple of weeks.
Great, looking forward to it. Thank you so much, Dave. And if anyone has additional questions, please feel free to email me, phastings@barometercapital.ca, or you can reach out to David. We're always happy to address your questions. And thank you so much for continuing to join us every Wednesday at 4 p.m. We appreciate it.
Thanks, everybody.
Thank you.